Imagine waking up one morning. Like every other day, you reach for your phone to check your bank account, but the app won't open. You tell yourself, it's probably just a temporary system issue. So, you walk to the nearest ATM. A single message appears on the screen. Out of service. It's annoying, but you're still not worried. Then you stop by the grocery store. When you get to the checkout, you hand over your debit card. The cashier shakes their head. Sorry, cash only. As you step back outside, you notice long lines forming in front of bank branches. Shopping carts are overflowing. Gas stations are packed with cars waiting their turn. That's when an uncomfortable feeling begins to settle in. What if something is actually wrong? And suddenly, a question you've probably never asked yourself before comes to mind. Is the money in my bank account really mine? It sounds like the opening scene of a movie. But it isn't. And this didn't only happen in struggling economies. Even some of the world's most advanced countries have experienced it. Every single time the same reality came to light. People suddenly lost access to the money they believed belonged to them. One of the clearest examples happened in Argentina in 2001. After years of debt, economic mismanagement, and poor financial decisions, people began losing confidence in the banking system. Everyone rushed to do the same thing: withdraw their money. To prevent the banks from collapsing completely, the government made an extraordinary decision. Cash withdrawals were heavily restricted. Dollar-denominated accounts were forcibly converted into heavily devalued pesos. Within weeks, millions of people watched the savings they had built over many years lose a large part of their value. The streets filled with protests because people hadn't just lost money, they had lost trust. Years later, history repeated itself, this time in Cyprus. In 2013, the country faced a severe banking crisis. Do you know how they responded? A portion of large bank deposits was simply taken. People painfully discovered that the money they had trusted the bank to protect wasn't entirely under their control anymore, and the people who suffered the most weren't billionaires. They were small business owners who could no longer pay their employees, parents struggling to cover their children's education, retirees who suddenly couldn't access the money they depended on. A few years later, Lebanon experienced a remarkably similar crisis. People had millions sitting in their accounts, yet they were allowed to withdraw only a few $100s each month. Think about that for a second. The money is yours, but you can't use it. The desperation became so overwhelming that some people walked into bank branches carrying guns just to get access to their own savings. So, was this only happening in developing countries? Not at all. In 1933, even the United States. The country many people consider the financial center of the world was forced to shut down every bank in the nation for 4 days. People couldn't withdraw their money. Businesses couldn't pay their workers. The economy nearly came to a standstill. Looking back today, these events may seem like completely different crises, but they all shared one thing in common: the way banks actually work. Most of us assume that when our paycheck arrives, our money simply sits inside a vault waiting for us. But that's not how banking works. Banks don't just store your money. They put it back into the economy. They lend it to borrowers. They finance businesses. They purchase government bonds. In other words, the same money is being used in many different places at the same time. And that's exactly why the system becomes vulnerable. If everyone tries to withdraw their money at once, the bank simply doesn't have enough cash to satisfy everyone. That's how a bank run begins. In reality, banks aren't held together by the cash inside their vaults. They're held together by something far more fragile: trust. As long as people continue trusting banks, the system appears to work perfectly. Paychecks arrive. Cards go through. Loans are approved. Life moves on as if nothing could ever go wrong. But the moment that trust begins to crack, everything changes, because the banking system is, at its core, built on confidence. And the moment enough people say, "I want my money back now," the system can no longer keep up. That's why during financial crises, governments often move to protect the banks before they protect individual citizens. At first, that may sound unfair. But from their perspective, if the banks collapse, the economy collapses with them. Businesses can no longer pay their employees. Factories can't continue producing. Supermarkets can't pay their suppliers. In other words, it isn't just the financial system that begins to break down. Everyday life starts falling apart. That's why we've seen the same measures repeated throughout history. Withdrawal limits, frozen bank accounts, capital controls, all introduced for one reason: to stop people from rushing to the banks. But here's the real question. Were these measures designed to protect people or to protect the system? History seems to give us the same answer over and over again. When a financial crisis hits, the people who pay the highest price usually aren't the ones who caused it. They're ordinary families. Workers who spent years building their savings, retirees, small business owners. People who wake up one morning only to discover they need permission to access their own money. Today, everything feels easier than ever. We carry our banks in our pockets. We can send money with a single tap. Cash is slowly disappearing from everyday life, but there's a hidden consequence. Our access to money has become more dependent on digital systems than ever before. If your phone stops working, if the servers go down, if the payment network fails, or if your account is frozen for any reason, the wealth you thought you had can instantly become nothing more than numbers on a screen. That's why real financial security isn't simply about how much money you own. It's about whether you can actually access it when you need it most. So what's the answer? No, it's not emptying your bank account and hiding cash under your mattress. History has shown that panic almost always makes things worse. The real solution is resilience. Don't tie all your wealth to a single bank, a single investment, or a single financial system. Keep some emergency cash. Diversify your assets. Spread your risk across different forms of wealth. Because true financial security isn't measured by how much you earn. It's measured by how much freedom you still have when everything around you becomes uncertain. And perhaps even more importantly, we need to understand the financial system instead of blindly trusting it. These risks don't exist because banks are inherently evil. They exist because this is how the system was designed. The same system that fuels economic growth, makes borrowing possible, helps businesses expand, and keeps modern economies moving. But that same system also depends entirely on confidence. And anything built on confidence is by nature fragile. That's the part most people never think about. Banks look powerful, but what truly keeps them standing isn't the money inside them. It's the belief that they'll always be there tomorrow. The moment that belief begins to disappear, even the largest financial institutions in the world can find themselves in serious trouble. Argentina learned that lesson. Cyprus learned it. Lebanon learned it. Greece learned it. Even the United States learned it. None of those countries expected it to happen. In fact, they all believed they were safe, right up until they weren't. Maybe that's the most important lesson this video has to offer. Seeing a balance in your bank account is not the same as truly owning that money. Real ownership means being able to access your wealth whenever you need it. That's where financial freedom really begins, not with making more money, but with understanding how money actually works, because history keeps delivering the same warning. No financial system remains unshakable forever. And when the next crisis arrives, the difference between those who remain calm and those who panic won't necessarily be how much money they have. It will be how well they understood the system before it was tested. One day, the question may no longer be, what if the banks shut down? Instead, it may become something much more personal. If they do, how free am I really?